Okay, so let's kick off. Morning again, everyone. My name's Steve Richardson, and I'm going to be your moderator today. I'm going to be managing your website webinar questions rather, and hopefully making sure that everything runs reasonably smoothly. So today's webinar is, as you know, bolstering your balance sheet. It's great to see so many of you here today. It's going to be a very interesting 60 minutes, I think. Personally, you know, I love a good balance sheet, but there again, I would say that, wouldn't I? But seriously, if you can improve your balance sheet, it means that you're improving your business, and improving businesses gives happy owners. So this is a really, really important webinar. Let's just run through the Zoom features as normal. You can select your audio settings to test your speakers, make sure you can hear us. You can submit questions via your Q&A button, which is in the middle of your screen at the bottom. Let us have as many questions as you'd like, and we'll try to answer those at the end. And if you do need to leave the meeting, then you can rejoin using your original link. Okay, so today's panelist is my colleague and co-director, Steve Price. Over to you, Steve.
Thanks very much. Thanks very much for the introduction, Steve, and thank you to all of you for making the time to join us once again this morning for our monthly webinar. So today's session is all about building a better balance sheet, and that can initially seem a little bit technical and a little bit daunting, but bear with us on this one, because we're hoping to get you clearer on the power and the opportunity that lies within the balance sheet. So before we get stuck in, I just want to throw in, I guess it's our usual disclaimer, this is an educational webinar, and we put it out there for your general information, and we must just stress it is no substitute for tailored advice specific to your own circumstances. I know that's obvious, but this is just general advice now, which will hopefully be educational and, dare I say, interesting for you today. So here's what I'm going to cover in this session. We're going to talk about the balance sheet, the story it tells us about our business, and we're going to discuss some practical and proven strategies to get your balance sheet stronger. We'll also cover your 4 most important areas of focus, as well as ways to maximize business value, and then some best practice tips, as well as your next steps, and of course, as usual, how we can help. We've got the Q&A session at the end. Steve's already mentioned that, but again, just if you do have a question at any point throughout this, stick it into that Q&A, and we will do everything we can to cover that at the end. So let's get started. Often we see business owners focusing all their energy on the profit and loss statement, and they're looking at ways to drive up revenue, drive down costs. And yes, okay, that's important. Unless there's a focus on the balance sheet as well, profitable businesses can and do still go broke. For example, if you drive up sales, but you don't have a great system for invoicing your clients, or maybe you're not very good at collecting the money that they owe you, the business can run out of cash. And, you know, for most people who are on today's webinar, if you've been tuning into our regular webinars, this is a message we've been giving all this year throughout the pandemic period. Likewise, a growing business may overinvest in stock, and then if we can come to a downturn, like perhaps some businesses are experiencing right now, then they find it difficult to move this stock and convert it back into cash. So cash is often described as the oxygen for the business. There are many ways to increase cash flow, and I'll be covering that shortly. The balance sheet is where your cash gets measured. There are some useful calculations that can be done to show you how much cash can be created by influencing other numbers on the balance sheet, and these are such as debtors, the stock, or the work in progress. And just as your bank will look at your balance sheet to see if your business is solvent, so should you. Trading while insolvent is not only extremely stressful, as you'll find it very difficult to pay your bills, but it also potentially puts you personally at risk with creditors and also the tax authorities and even finance lenders. So we're going to show you today how to test at a glance if your business has that oh so important solvency. Now, in a downturn, it's important to make sure you're not drawing too much out of your own business for personal spending. Tax bills generally lag behind the revenue that you're generating, so you could find yourself in a position where a surprise tax bill can't be paid because you've taken too much money out of the business for your own personal spending. And a personal budget update is strongly recommended for everybody at this time. Having a reserve of cash is obviously essential in times of economic downturn. If profits are down or if you're making a loss, a strong balance sheet can see you through at least a short-term period of this until profitability is restored. And that's a very key message for what the balance sheet can do for you. So now we know why we need to focus on the balance sheet. Let's talk about what it actually tells us. So your balance sheet, it's also known as the statement of financial position, provides a snapshot of your business's financial position at any specific point in time. It measures the net worth of your business, which is your assets less your liabilities. It also shows, as we've already said, if your business is solvent. So if your liabilities are greater than your assets, business is insolvent, and action is going to be needed to fix that situation. You can also compare different periods to determine whether the business's net worth is increasing or decreasing between years, and you can track the strength of your business. The stronger your balance sheet, the easier it will be for your business to survive a downturn. There is no disputing that fact. It also provides a basis to calculate some of the key ratios, such as debtor days or stock days and working capital. So let's just take a chance to have a look at an example. Okay, so for this example, we're going to use an imaginary building company. The first part of the balance sheet is the equity or what we call the owner's interest in the business. And you can see here that last year the company made a profit of 71,554, but this year it's made a loss of 45,857. So the total equity at this point now is £2,087, which means if the company goes on to make further losses, it's going to end up insolvent. Strategies to improve the profitability need to be implemented urgently to avoid this. So we'll build the balance sheet as we go to help you understand the layout. So the company has a current bank account, but you'll see shortly that it's also running an overdraft. So a current account like this is a great way to build up cash reserves for tax payments and any further downturn in trading results. There's income tax receivable or PAYE receivable of 5,375, which means that too much tax has been paid during the year at whatever point, and so obviously this would have itself caused a drain on cash flow. The opposite can also happen, where can sometimes be a surprise tax liability when the financial statements are done, which can put pressure on cash flow. Having a regular update of your tax position throughout the year helps ensure you don't pay too much or too little tax. So let's have a look at the stock or the stock on hand. In this case, it's increased by £33,000. And again, that's a further drain on the cash flow of this business. Holding too much in stock can put pressure on a business, as that stock first has to be sold and then the funds then collected from the debtors. On the flip side, in this particular case, work in progress has reduced by £47,000, which is good news, as the higher the amount tied up in unfinished work, the longer your cash is tied up. So in this example, work in progress could perhaps be the value of the wages paid on jobs that we haven't yet invoiced out to the customers. So the shareholder advance account, or what we sometimes call as the director loan account for small owner managed businesses, this is showing an asset £66,400 494. So in other words, the shareholders owe their own company just under £66,500 in debt. Clearly, that isn't good, because if the company fails, a liquidator can demand this money from the shareholders. They can demand that that money is paid back, and they won't have the protection of limited liability, so they'll become personally liable. Sometimes we come across instances when we're talking to clients where that they don't realise that. It's a very important point we need to make in this webinar today. You can also see that the balance owed, okay, it's 66,000, but it's also increased by 32,000 over the year, which indicates that shareholders are taking more cash out of the business than what they're entitled to. So if we take a look at accounts receivable, or what we know as debtors, that's reduced to 82,000, which has freed up a bit of cash compared to last year. Now, if we refer across to the P&L, or the trading account in this business, we can calculate that it's taking 48 days to collect debtors. If payment terms are 7 days, that's obviously too high, and there's a significant amount of cash tied up here. Now, in terms of non-current assets, or fixed assets as we often label them, there's very little value tied up here. This could be a signal of eroding value, as fixed assets have dropped by 23 grand. In other words, some fixed assets could be in need of replacement, so there could be a future drain on cash reserves when these assets need replacing. Although the total reduction in total assets this year is only 15k, and what I'm referring to there is the reduction from 297 down to 282. We do need to remember that one of the assets that has increased is the debt owed by the shareholders to the company. So the true asset reduction, excluding the shareholder advance account, is in fact £47,000, which is a major concern. So those are our assets. Let's switch across and start to have a look at our liabilities. We can see in this case that the Visa credit card has increased dramatically. Now, again, that could be a symptom of poor cash flow. Credit cards really should be cleared in full each month, and obviously the idea here is to avoid the sometimes really high interest costs that they bring. If you're unable to pay your credit cards each month, it's probably about time we had a conversation, because maybe you should be restructuring that finance to avoid consistently high interest rates. So I referred to it before, but we also have a bank overdraft, and that's increased from, slightly marginally, from 36k through to 38k. We need to understand what the overdraft limit is and how close the company is running to this limit throughout the month. So often the most difficult time of the month for cash isn't necessarily the end of the month. It can often be on the day of paying wages, or even paying PAYE, the taxes associated with wages. So we need to make sure that there is a buffer of cash within the overdraft limit. A useful measure here is to see if the overdraft is reduced to zero at any point during the month. If the overdraft for the company, let's say, never goes below 20k, then that 20k is really considered to be core debt. It's not really shiftable as an overdraft would normally cater for. If that's the case, again, you should consider refinancing this to a business loan, again, to reduce or avoid high interest costs on a consistent basis. So let's have a look at the taxes. VAT is what we sometimes refer to as lumpy expenditure, because it's not generally payable every month. As you'll be aware, most people pay their VAT on a quarterly basis. So a good strategy to preserve cash flow is to put aside a set amount each month for your VAT and other taxes as well. I already talked about this using the bank, the current account from the bank for this purpose. Again, if you talk to us, we can help you work out a system to work out how much you should be setting aside each month for tax payments, so that you always have sufficient funds available. And we're already doing this with plenty of our clients, so that there's no surprises. Note here that last year the tax payable under PAYE was 15,747. And if you remember, I said this year there's a tax refund owing. By having regular updates of your tax position, large fluctuations, as in this example, can be avoided, which reduces cash strain and also your stress levels. So just a quick note that there's been a loan here for a phone as well. This is what we call asset finance. And again, the interest rates are often much higher than bank finance. So be careful accepting finance deals on things like mobile phones or similar pieces of equipment needed in your business, again, because of these interest costs. Perhaps the biggest indication of cash strain in this business is that trade and other payables have increased significantly from 72k through to 111,000. If we refer to the trading accounts cost of sales, we can calculate that it's taking 74 days to pay our suppliers on average. Now, last year, if we realize it was only 47 days, not having sufficient cash to pay suppliers each month is incredibly stressful, as well as being risky. And we're going to have a look at how to calculate that in a further slide. So we can see here that the company refinanced a loan. So in this example, we've gone from a loan under loan 70 into a refinance loan, what we're calling loan 71. And in the current climate, refinancing such as this may result in reduced interest costs. And we've seen that with the C-bills and various other financing that's been available this year. People have been able to switch some of their higher interest rates that they were paying on form of finance. But we also need to be mindful of the legal and the loan application costs in doing these switches as well. So with net assets of only £2,087, the company really here has no ability to borrow any further funds, or it will fail the second test of solvency, which is to always have their assets greater than their liabilities. And we'll go into that in a little bit more detail. So with the reduction of net assets of over £45,000, we need to be thinking about how we can bolster this balance sheet and reduce risk. Okay, so let's have a look at some specific examples of strategies that we can adopt to do that. In the current climate, it's likely that many company balance sheets would have taken a hit from a downturn in business. What's important is to focus on what you can control and adopt practical and proven strategies to bolster your balance sheet. So let's have a look at what some of those might be. We've broken it down into what we see as 4 areas of focus for building the balance sheet strength. So let's go through those four areas right here. Number 1, let's focus on increasing profitability. I bet you could have guessed that one. That is the most obvious one. So obviously in the current climate, that's incredibly important. Not easy, but important nonetheless. Number 2, focus on improving cash flow. And there are a number of ways to do this, which I'll be explaining later as part of this presentation. And again, the sort of thing which we have mentioned on various presentations throughout this summer period. Number 3, focus on solvency. That is whether your business can pay its debts as they fall due and whether assets are greater than liabilities. So having real-time, up-to-date information is very important to determine this solvency. And then number 4, focus on the DLA or the shareholder advance accounts. These measure whether you're taking more funds from the business than are owed to you as shareholders. Having a dividend and drawings policy is really essential to ensure you don't end up with an overdrawn loan account. And I've already said it, but I'll make the point again, liquidators, if we do get to that stage, can chase you for this personally for the balance owed. So revising your own personal budget perhaps is equally important to enable you to do that. Let's have a look at number 1 of these 4 areas then. And we said that was looking at focusing on our profitability. And the best way to increase your profit is to choose one or two, perhaps even more, of the 7 ways to grow your business. So we've broken down here, and we did a very similar thing. It seems so long ago when we were allowed to run seminars, but we did this last Christmas to a group of our clients about how we go about increasing profitability. Some of these you'll be aware of, some are obvious, and some, you know, we may know about them, but are we doing something about them? So let's have a look at them. To increase customer retention, build a plan to delight your clients. Under promise and over deliver, so that they refer more customers to you and don't defect to your competition. How about generating more leads? Focus on your marketing, especially via referrals, possibly even testimonials and social media, as these are all relatively low-cost strategies or cost-effective strategies. To convert more prospects into customers, look at strategies that will increase your proposal or quote acceptance rate. Perhaps some sales training sometimes can help here as well. To increase your transaction value, implement strategies to encourage customers to spend more with you every time they buy. Perhaps offer options to upsell and pick up on that very well-known concept of offering fries with that. To increase your transaction frequency, look for ways to encourage your customers to buy from you more often. So, for example, offer loyalty benefits, a reminder service, or just simply staying in contact with them. So you know, you're always at the front of their mind and you're making it easier for them to buy from you. To reduce your variable costs, identify strategies to eliminate wastage and rework. Also consider negotiating better buying strategies with your suppliers. And finally, to reduce the overheads, or perhaps the fixed costs in the business, review these at least annually to ensure you're getting the best deal and that they're still required. So, for example, if more of your team are working from home, could you downsize your office space or reduce the rent? Or could you get a better deal on your utilities by changing providers? Have a look at area number 2. The second area of focus to bolster your balance sheet after building the profitability is then to go and have a look at the cash flow. And we're going to sum this up using the cash conversion cycle. It shows you how long it takes to receive payment from your customers after originally buying stock from your suppliers. So in other words, how long is your cash tied up in inventory or work in progress if you're a service company, and in accounts receivable or debtors. So let's have a look at this by way of example. So we buy stock from our suppliers on day 0. That's the start of our cycle. We then, in this particular example, we pay for that stock 35 days later. And on average in our business, it takes 65 days from the moment we receive that stock to sell it on to the customer. This means that our average stock holding covers a period of 65 days. And then let's say it takes an average of 110 days to receive payment from customers. So our average receivables is the difference, which is the 45 days. So to calculate our cash conversion cycle, we add our average stock holding and receivable days together, and then we take away the average payable days. I hope that makes sense. I hope you can follow this diagram as we've built it. So this gives us a cash conversion cycle of 75 days. It takes us 75 days before, once we've parted with our cash, before we get it back again, presumably or hopefully at a profit. So let me ask you this morning, do you know what your cash conversion cycle is? Have you ever taken the time to measure it, let alone to understand if there's anything you can do to improve it? You might well get a surprise. Ultimately, cash is king, and you want your cash conversion cycle to be as short as possible. So the more cash you have in your business, the stronger it will be, and the more adapted it can be to weather downturns. Technically, if you increase cash by collecting debtors, your net assets aren't going to improve because your debtors will go down, but the cash will go up. However, the higher your debtors are, the more risk there is of them not paying, and also the quicker you can convert your debtors and stock into cash, the stronger your business is going to be. Also, if you can negotiate better terms for payments with suppliers, you can preserve your cash flow for longer as well that way. Care is needed here though, as in the current economic climate, slow payment of suppliers can put a drag on the whole economy and the whole relationship with them. What's important here is to come to an agreement with them. So for example, they might agree that you only pay when you've sold the item to your customers. That would be a fantastic agreement to be able to strike. You must also look at how long it takes for your stock or your work in progress to be invoiced. The quicker, obviously, the better. This is about getting more internal efficiencies. So consider whether you need to hold so much stock, or if you can issue progress invoices, or in fact reduce the number of jobs you have on the go at once. Make sure you're also keeping a close eye on how long it's taking for your debtors to pay you. There's so many things you can do to get paid faster. So we can talk about updating your terms of trade, automating your invoicing process, or simply chasing up your slow payers with a systemized process for credit control. And we ran a webinar, I think possibly 3, maybe 4 months ago now, called Getting Paid. It's still on our YouTube channel. It was full of absolute gold of how to increase that particular part of your cash cycle. So let's look at some examples. Again, we'll go back to our building company. Okay, so let's have a look at what we can do then. So in this case, start to have a look at our stock. We can see that it's taking 38 days to sell, whereas last year it was only taking 15. If we can reduce the days, that number of days, by 9, then we can free up £13,503 in cash. So moving on, work in progress is taking 10 days to invoice, which is, in this particular example, it's much better than the previous year, which was 41 days. If we start to implement, let's say, weekly progress invoicing, and we can get that reduced even further by 5 days, because obviously if we're going to do it weekly, we can get that right down to 5 days, then we can then go on to free up another £7,502. Now, of interest, let's have a look at last year when it was taking 41 days to invoice work. If we've been able to reduce that by 25 days, there's £38,000 worth of cash that can be added into the reserves of the business there. So really, really viable in this example. In this example, continuing, the debtor days have been pretty consistent. Okay, they've gone from 45 out to 48. Now, if we can reduce that by 18, so we're getting it down to 30, which might well be what our terms suggest, and that's going to help us free up another £31,000 in cash. So then if we have a look at all this and we add to the cash what we could free up by reducing our inventory days, our work in progress days, and our debtor days, as we just worked through, that's going to put another £52,000 worth of cash into our business. And last year, if we'd have done that, the figure's even bigger at 91,000. Now let's have a look at the other side of this, cash going out. In this example, we're saying time it takes us to pay our suppliers is 74 days. Now that might sound okay in terms of holding cash, but the question is that really sustainable? So let's have a look at trying to reduce that by 30 days so that the company is staying current on payments owing, and you're not upsetting and risking your relationship with suppliers. Now that's going to cost us £45,000 of our cash. So if we have a look at that overall, we've generated a surplus of £52,000 worth of cash. At the same time, we've released an extra £45,000 worth of cash to maintain that relationship with the suppliers. And so we end up with the overall cash improvement of £7,102. £136. The key thing here is that life is going to be much less stressful in this position. So not waiting so long to get paid and being able to keep up with suppliers without them constantly chasing a buzz. It's a much stronger position, both in the balance sheet and also for our own stress levels as owners of the business. Let's keep moving on. And so to recap, our first strategy was to build profitability. The second one was to improve cash flow. So let's have a look at the third area of focus now, which is to maintain solvency. And as mentioned previously, there are two components of solvency, and these are often sometimes referred to as the first and the second limb. So firstly, the ability to pay debts as they fall due, which is measured by ensuring that current assets are greater than current liabilities. And the second part of the test is to ensure that total assets are greater than total liabilities, not just the current ones. So let's take this area of focus back to the example. Here we've taken the current assets and the current liabilities section of the balance sheet to calculate what's called our current ratio. So the current ratio tells you if you're able to pay your debts as they fall due. To calculate the current ratio, we divide the total current assets by total current liabilities. I do realise I'm getting slightly technical here, bear with us on this. So we can see that in 2020, our current ratio is 1.31. So what that means is there is £1.31 of current assets for every £1 of current liabilities. And as you can see in the previous year, that figure is 1.55 or £1.55 of current assets against every pound of current liabilities. But if I'm still keeping you on the story from earlier on, remember, we need to adjust out the shareholder advance account because it's not really a realistic current asset, because these shareholders are not going to pay this money back. This is their drawings from the business. Sorry, I've clicked too far. So now we can see that there's actually only 92p of current assets for every pound of current liabilities. When that figure dips below 1, the company is technically insolvent. So to fix this in the long term, we need to go back to the first of our strategies and increase profitability. That is how the company in the long term stays viable. But in the short term, the company either needs an injection of cash from its shareholders, or part of the bank overdraft needs to be converted to a longer term loan. I'll talk more about the shareholder advance account shortly, but first let's have a look at the second part of the solvency test, and this is checking whether total assets are greater than total liabilities. Okay, so our net assets, or total net assets less total liabilities, appear to be positive here at £2,087. However, if we exclude the overdrawn shareholder advance account, the company is actually insolvent by 64407. So the company needs a short-term cash injection to see to this. It's got to be at least 66,494. So let's say we put 70,000 in. So by doing this, we can eliminate the bank overdraft and the shareholder advance account becomes a liability of 3506. So now our true net assets are £2,087. Of course, the company still needs the previous strategies. It's still, you can't walk away from needing to increase profitability and increasing cash flow, but at least the two limbs of the solvency test can now be satisfied after this action has been taken. Which brings us to the fourth and the final area of focus to bolster the balance sheet, and that is managing these shareholder loans. They're an area we're going to have to focus on. I've already covered the risks associated with running an overdrawn director loan account. I'm gonna use those two terms interchangeably because just about all of our clients are owner managed businesses. So just to make sure I'm not causing confusion here, a director loan account and a shareholder advance account or loan account are the same thing in the principles we're talking about here. The main risk is that if your company gets into financial difficulty and a liquidator is called in, your personal assets may be at risk, as the loan is likely to be called up by that liquidator on you personally, or the shareholder personally. A great way to avoid an overdrawn shareholder account, therefore, is to update your personal budget so that you can reduce, hopefully, the amount of drawings you take from your company. Personal budgeting is a rewarding and empowering thing to do, especially in the current economic climate. I know it's something that in 2020 a lot of people have either chosen or sometimes had to do. It's also something we can run in a future webinar if there is a call for it. I would encourage anybody who wanted our help beyond just mentioning it. We could run a webinar specifically on how you go about personal budgeting if there's call for it. You know where the Q&A is. Please put a comment in there if that's something you might be interested in us covering. I think me and Steve will be more than happy to do that. So look, if we're going to be on the topic of personal budgeting, set a regular weekly or monthly amount that you take from the business and try and stick to it. That's going to help you manage the cash flow in the business. And lastly, to protect you in the event the business does get into financial strife, possibly having security or advance for the advances you've made into your company ensures that in a liquidation you stand a higher chance of getting your money back. It's not often something we talk about, but if you're going to introduce funds into your own business, are there securities you can put against those? It's a very worthwhile question. So to recap, okay, I do apologize. I've covered a huge amount of detail there, and I have gone slightly more technical than we sometimes need to. Sometimes choose to, but I think we did need to in this particular case. The main message from today is that your balance sheet is fundamental in assessing your business strength. There's so many things you can do to bolster that balance sheet. So we've looked at strategies to build profitability, improve cash flow, maintain the solvency, then obviously manage the shareholder advance accounts or the DLAs. So our aim is to help you take what you've learned today and implement some positive change in your business. So what are your next steps going to be? We've made this point before, but doing nothing is not an option. Doing nothing is still an action. It's just an action that doesn't carry you anywhere. As we've said many times before, doing what you have always done is unlikely to give you the same results as you've had in the past. And remember this analogy of putting the oxygen mask on yourself first. Plan for your own sustainability. It starts with you and the leaders in your business. Make a clear plan for the steps you'll take to bolster your balance sheet, and focus on what you can do as opposed to worrying about what is out of your control. Finally, as we always say, we are here for you, to support you and help you in this. How can we do that? So we put this slide in at the end of our webinars and presentations to you. This is not, or we hope it's not, seen as any form of hard sell. We always try and ensure that there are free services, and when we run these webinars, people use them, people contact us. There is a survey form that you will be automatically directed to as you leave this webinar today. And if you want any of these free services, number 3 and 4 on here, then we will be only too pleased to send them on to you. You've just got to ask for them, and they'll come over across to you. So look, we can, for the firms that really do need a level of hand holding, a level of enhanced support, we can help you forecast your cash going forward. There's a lot of firms needing to know that position at the moment, and we can arrange a fee with you individually to do that exercise with you. Perhaps that's not all it needs. Perhaps it needs ongoing support from us in the form of coaching and helping you really to take on some of the principles that we've talked about in today's webinar. and we can start to work with you on an ongoing basis, and I've given you an idea of what the costs on a monthly basis might be. And then the balance sheet health check is a means really of summarizing a lot of the things we've covered today to give you a checklist in your own business at how you go forward. Is it something that you could use? If it is, just ask us for it. We've prepared it for you. You can take it for free. And of course, if you want to sit down and talk to us about this, if there's something that's hit a point or a chord with you today, I really need to be talking to my accountant more about that particular subject, ask us, and perhaps myself, perhaps Steve, or perhaps somebody else in our team will take that time to spend with you, and that will come without charge. Okay, I'm going to ask Steve to take his microphone off and come back into the webinar. Steve, have we been asked any questions?
Thanks, Steve. Yes, 3 at the moment, but keep them coming if anybody has any others. So, hi Diane, you're first. So, what do finance companies look at when you apply for finance? So possibly, motor finance or bank loans, stuff like that. 2 things I would say. The first one has got to be net working capital. So that term is basically the difference between your current assets, which Steve's mentioned before, which are cash and debtors, and your current liabilities, which are your trade creditors, or the creditors, and your tax creditors, VAT, PAYE, corporation tax, stuff like that. So that net working capital, it's a measure, if you like, of the company's liquidity. If it's positive, in other words, if your current assets are more than your current liabilities, then generally the company has potential to grow, and is a better bet, if you like, for a finance company. If it's negative, so your current liabilities are more than your current assets, then chances are it may have difficulty paying its bills, and it could run into trouble. So much less of a good bet for a finance company. The other one, sort of briefly, that I would mention is what we call debt to equity, and that ratio basically is the amount of debt that a company has divided by the amount of retained earnings. So if you, for example, you've got a company with £100,000 worth of debt and £20,000 worth of retained earnings, then one divided into the other is a ratio of 5. That's a very, very risky company. On the other side of it, company has £50,000 worth of debt, let's say, and £100,000 worth of retained profits. That's a pretty healthy company. The debt to equity ratio is just a half, 0.5. So it's very low risk, and much more likely to get a loan from a finance company. So that's that. Hope that helps, Diane. Dave, good one. What can the public see when they look at a company at Companies House? Generally speaking, for small companies, Dave, all they can see is what we call the abridged accounts, which is basically the balance sheet and the accompanying notes. They can't see the profit and loss account unless the directors have specifically decided that they want to disclose that, which is highly unlikely. So again, going back to a finance company, they're going to make their judgment just on the balance sheet, rather than the profitability of the company in any one year. Finally, Angela, yeah, this is something that Steve's covered, but it's probably worth just reiterating. If a company goes into liquidation, with the director's loan account or the shareholder's loan account basically in debit, so that the directors or shareholders owe the company money, what happens? There's been a lot of stuff in the press about this recently, because obviously, due to the current situation, we're seeing more and more company insolvencies. So an overdrawn director's loan account is treated by the liquidator, the insolvency practitioner, who's been appointed to run the company's affairs, as a debt to the company, and he will pursue that debt, whether it's shareholders or directors. His job is to get as much money in for creditors as possible, so he will pursue that debt. It's a dangerous route to take, and as Steve mentioned in the webinar, really should be avoided wherever possible. Okay, so here we go. Francis, morning. What if DLA is positive? That's good. Well, yeah, it's got to be a lot better than negative, certainly. So if a DLA is positive, that means that the company owes the director money. That could be because the director has put money into the company to support it. It could be that dividends have been voted and they haven't all been taken by the directors, they weren't needed. So yeah, a positive DLA is generally you know, a good thing, but there again, you know, there has to be a good reason for it, if you like, why the directors haven't taken the, you know, the cash out. Is it to support the company because the company is not doing very well? There's lots of different scenarios. Izzy, morning. Is it acceptable to include potential sales in the balance sheet, i.e. we give the customer a contract price and then take a regular drawdown, so the full sale is not entered until the end of the contract? I take it accrued costs would need to be included, or would this just muddy the waters? Steve, do you want to take that one?
Yeah, so we've got to be very careful on that. This comes down to a point of what's recognised as accounting law, which is at what point can you recognise trade in the business. So you've mentioned about a contract price there, and there are circumstances in which, as you've rightfully, well, you've talked about accruing costs, but there are circumstances in which we can what's called accrue revenue. Got to be very specific on that, and is it, if you've got a particular contract in mind, we would need to speak about that specifically with you to understand. So I'm not saying it can't be done, but we've got to be very, very careful in how that's applied. But if it can be done, yes, you're absolutely right. We can increase the trade position for the year, and that will therefore increase the value of the balance sheet. The downside, of course, I'm sure you're already onto this, is by increasing the trade position, you are effectively forward paying that tax as well. So the corporation tax payable on that period, if it shows a better trading position, will be higher as well. And so you just have to be aware of that as well. So Izzy, if you want to follow up with that, please put a note in the exit survey, and we can talk specifically about a specific contract you might be referring to. But it's a possibility. Let's just leave it as that for the time being in general terms.
Thanks, Steve. Phil, do trade insurance companies look at the same aspects as finance companies when assessing what limits to apply on the company? Yes, for sure, Phil, they do. Same types of things, certainly. The net working capital, what we call the current ratio, debt to equity ratios, stuff like that. So yes, absolutely. They're all looking at the same things, really. And finally, Paul, is a positive DLA, director's loan account, offset against corporation tax? Unfortunately not, Paul, no. The two have no correlation, really. No. Okay, so that's the last of the questions, Steve. So
just scroll down, Steve. I think
wait a minute. Oh,
there's
sorry.
Another one again from Paul.
One from you. Sorry. I'm tempted to leave set up personal investment in the company to keep cash flow healthy. Is this wise? Well, this is what we're talking about with a positive DLA, Paul. If the company needs your investment, then clearly, if you're happy to keep it in there, then yes, keep it in there. There is always the opportunity to actually charge the company a commercial rate of interest for the money that you lend it. Talk to us about that if you'd like to know more. If the company doesn't need your investment, then take it out and stick it on deposit somewhere else. Christopher, good morning. Will bounce back loans potentially have a negative effect on credit ratings? Good question. If not repaid before year ends. Funnily enough, we've come across one or two cases with car financing where they have been rejected because the company has applied for bounce back loans that was pretty early on in the process. And I think possibly that will be reviewed by finance companies. But it is possible that the fact that the company has actually put more borrowing onto its balance sheet, that could affect its credit rating. Depends on the company. Also from Christopher, could there be a critical point to repay these loans? That's a difficult one. I mean, clearly the governments have said, as far as bounce back loans are concerned, that the first 12 months they'll pick the interest up and there'll be a repayment holiday, and then you've got a period of between 5 and 10 years to repay those loans. I don't think there's a critical point that you could say generally, but that would be really something to look at, each individual case for each individual company.
Could I chip in there, Steve, as well? Just on that last one. Yeah, I think particularly with bounce back loans this year, obviously we've seen more lending or business lending than we've ever seen before, and in talking to our clients and to other businesses as well, there seems to be a split in those businesses that needed a business bounce back loan and those businesses that chose to take one as a buffer, if you like, as a buffer to cash flow. And we've covered those sort of areas in terms of bolstering your balance sheet as well. But don't see the comfort blanket or the buffer zone of a bounce back loan as the only means to protect you from the future, going forward against any adverse trading situations. The real way to create that buffer zone is to plan and forecast your cash. Now, yes, you can plan today and in 2 months it's out the window because circumstances has changed, but planning is a continuous thing that you should be doing at the moment. There's the real comfort blanket. And sometimes, to answer the point of the critical point to repay those loans, it's your own cash flow analysis which is really the thing that should be answering that. I hope that gives you a little bit more in-depth answer there, Chris, and anything beyond that, really we'd have to talk specifically about your business going forward, which obviously we can do. It's up to you.
Thanks, Steve. James, with a positive balance sheet, what's the best or most appropriate way to withdraw funds in a tax efficient manner? There's no one size fits all, actually, James. Clearly that will depend on on the balance sheet, basically whose it is and what it looks like. Generally, you can withdraw funds from a company by way of, or if you're a shareholder, by way of dividends. Those dividends are taxed, basic rate at 7.5%, or higher rate at 32.5%. Higher rate kicks in when you're earning over 50,000 a year in total. So that's one way of doing it. Clearly, if you're a basic rate taxpayer, then it's a relatively cheap way of extracting money from a company. There again, if you want to reduce corporation tax, then it may be you would want to increase your salaries. But with that comes employers and employees' national insurance contributions, even though you're getting the corporation tax deduction. There's no one size fits all, James, for that. But you know, if you'd like to know more, then please get in touch. And finally, Paul, thank you for your kind words. Paul says, if you are a client of Inspire already, seriously consider moving your account to them. Thank you, Paul. Cheers, everybody. Here's Steve.
That's a great way to finish the seminar. Thanks very much, Paul. That's brilliant. So I hope you've taken something from today's webinar. There's been and perhaps I do need to apologise for the level of technicality, but you know, the detail, especially through these difficult times now, you really do need to keep an eye on what all the points you've made today. And if you're still left wondering or with questions, then I can only stress it once more, you do know where we are. There's an exit survey. It's going to take you less than 2 minutes to fill in. There's your chance to reach out to us. Other than that, thank you for your attendance this morning. We will see you at the, hopefully see you at the December webinar. We are still planning on having one, and actually plans are already in place for what that's going to be. It's all about time management and what we're going to call recapturing your time. This is the real holy grail for a lot of business owners. Time is a very, very finite resource, and sometimes we realize that we simply don't have enough of it. So we're going to build a webinar around that in December, and I'm really looking forward to sharing that with you. Thanks for your attendance again, and yeah, we'll see you this time next month. Thank you, and bye-bye.
Thanks, everybody. Have a good day. Bye.